Hey everyone, Donnie Schultz from Brace Home Loans here with Market Update. It is Monday, March 13th, 2023. Really good day for Market Update. We're coming off of a historic weekend. We saw the second and third largest bank failures in U.S. history. Silicon Valley Bank on Friday and Signature Bank on Sunday. There was a third bank failure earlier in the week, much smaller, Silvergate. But we are seeing some cracks in the foundation here. Markets are trying to digest this. They're trying to decide whether these bank failures were outliers or if this is a sign of bigger things to come due to the Federal Reserve's policy stance and policy shift over the last year to fight inflation. So we've talked about it on all the previous updates. The Federal Reserve has been increasing the federal funds rate. They've been tightening monetary policy to reduce inflation. And the consensus is that the Federal Reserve is going to hike until they break something. These are signs of something breaking. There's some debate as to whether this is going to turn into a bigger financial crisis or if the steps taken by the U.S. Treasury yesterday is going to nip this in the bud and calm things down. We will see how this plays out, but there's definitely going to be pressure on the Federal Reserve to pause the rate hiking, and see how the banking system regains its composure here. So really, to understand what's happening with rates, we have to understand why these bank failures occurred, and I'll try to keep it really simple. So, if I was depositing money at a local bank and maybe I had $100,000 to deposit, that bank is required to keep 10% of the money I give them in cash, liquid, ready to go. The other 90%, what the bank is going to do is they're going to invest that money, and that's how the bank makes their money. They're not going to invest in stock options or risky investments. What the majority of regional large institutional lenders are going to invest in are what are considered risk-free, safe assets, bonds, treasuries, mortgage-backed securities. These are safe investments that are going to lock that money up for a specific period of time. You could lock it up for a shorter amount of time, like a 2-year treasury, or you could lock it up for a longer amount of time, a 10-year treasury, up to a 30-year treasury. And the banks are going to invest this money that is going to return a yield to them, and that's how they make their money. They usually will pass on some of those earnings to a bank consumer, and that's what entices consumers to put money with the bank. Now, the issue that banks are having right now is the majority of the assets that they have money invested into have lost significant value this year because of the Federal Reserve's policy change. As the Federal Reserve increases the federal funds rate, the yields on treasuries, bonds, mortgage-backed securities moves higher. And the lower yielding bonds that banks have money locked into lose value. That's an unrealized loss. Banks don't have to show it. Most banks follow accounting practices. It's called mark to market. So, the bank is not selling those. As long as the bank is not selling those treasuries or mortgage-backed securities, they haven't realized the loss yet. But when investors start pulling money out or deposits significantly decrease, like we've been seeing over the last couple of months, banks are now in a position where they are forced to sell these assets. And they're selling these assets at losses. And when they're selling the assets at losses, if I gave, again, $100,000 to my bank, they kept $10,000 to the side, they invested $90,000, but now that $90,000 is worth $70,000 and I want all my money back, they're short. And that's the big issue that these three banks were facing. There are banks that are better, much more better positioned to handle this than others. The ones that weren't well positioned are the ones that are having trouble now. We've had 3 failures. We have definitely some more banks in the headlines. There are a list of probably 20 that are very high risk right now to have the same issue. Although the U.S. Treasury did step in and they've created a new fund, and they've come in and they said, hey, we're going to back depositors. So, some headlines will call this a bailout. It's not a bailout. If you invested in Silicon Valley Bank, or if you bought unsecuritized bonds with them, so non-U.S. Treasury bonds, maybe they were putting together their own asset classes, you have lost all of your money and you're not getting it back. If you were a company or an individual depositor who had a savings account with these banks, you will get all of your money back, and it's going to come from the fund that's being created by the U.S. Treasury. So what the U.S. Treasury is saying is they've created the fund. They're going to, guarantee the depositors for Silicon Valley Bank, for Signature. Those assets are going to be unwound, but they're going to be unwound against the U.S. Treasury, and other banks can now go and do that. So what the U.S. Treasury is saying is that if a regional bank has more depositors pulling money out, and we should probably talk about why depositors would pull money out. Last week, the 2-year Treasury yield was at 5%. So I could take my $100,000 and get 5% by putting it into a 2-year Treasury bond, whereas the bank could, was giving me 1.5%, 1%. So money was coming out due to that. We've had a big decrease in the stock market. We have seen economic cooling. We've seen depository accounts just lowering naturally, but there also has been money being pulled out because of the attractiveness of these higher yields, because the Federal Reserve is increasing their key rates. So money has been coming out. Now, if a bank is facing a liquidity crunch where there's more money being pulled out than what's available, that bank can go and pledge the assets that they're holding. So they could take their Treasury holdings, their mortgage-backed security holdings, pledge that with the U.S. Treasury. The U.S. Treasury will give them the money. They will do it at the purchase price of the value. So if that Treasury is down 30%, they're lending 100% of the initial value of that Treasury, and the bank's going to pay them 4 or 5%. So, it's an attractive option for the banks. It's not a bailout. If it's run properly, there shouldn't be any taxpayer subsidy for it, which is important. It should put more confidence into the banking system, where we don't see money being pulled out just to pull money out because a depositor is concerned about losing anything that's over the FDIC insured limit, which is only $250,000. And this does have the potential to end this crisis, before it really had time to snowball. But market participants are highly questioning whether the Federal Reserve can continue to increase rates. So up until Thursday of last week, before the first failure, Silicon Valley Bank, most market participants were expecting a 25 basis point to 50 basis point increase from the Federal Reserve. We had stronger employment data come out. We've had hotter than expected inflation data come out. The market was shifting and rates were moving back higher because we were really expecting the Federal Reserve to have to be more aggressive. Back in January, it was 25 basis points. That's what we were expecting from the Fed. Last week, it was 50. Now it's in between 0 and 25. Does the Fed hike? Do they hold pat? Do they say, hey, we're concerned about now the impact to the banking system? This is a sign that we need to get the effects of the rate increases into the system before we continue to move higher. And that's what we're seeing today. The 2-year Treasury is down 61 basis points today. It's down over 100 basis points in less than a week. That is a significant move. And that is showing that the market feels that the Federal Reserve, we've probably hit, we're near the top of what the Federal Reserve is going to be able to do. The longer term yields, they're not moving quite as much. The mortgage rates, we're not seeing them move quite as much as the lower end. And that's because if the Federal Reserve does have to stop, have they been able to do enough to stop inflation, or does inflation become a longer term problem? And maybe we have rates that are a little bit higher for a longer period of time. There's a lot that's going to play out here. Again, my thoughts are that the backstop that was put in place helps calm this situation down, but we can definitely not rule out that there's not going to be other banks that go under in the next few weeks. This is a dynamic situation, and we're seeing a lot of volatility. Tomorrow we have inflation. Does it matter? It does. Probably not as much as we would say it matters if we had sent this out on Wednesday or Thursday. I think the conversations right now are being had with the Fed. You have inflation tomorrow. You have their meeting next week. They're in a blackout period, so you're not going to see any Federal Reserve members come out and talk about this, but it will be addressed in the meeting. It'll be addressed in the press conference next week. Markets are going to be analyzing what the Federal Reserve members, where they put their dots. So if you're familiar with dot plots, that's the projection for the Federal Reserve of where they see the rate increases going over time. The market right now is pricing in that those dots are going to drop, that we are going to see the Federal Reserve, if not pause at this meeting, probably the next meeting, and they're going to hold. But right now the market's pricing in rate decreases from the Fed as early as September. And this is directly related to the pressure that is now on the banking system, and that is now causing banks to fail. So again, a lot going on. Super interesting weekend from a technical perspective, and why do these things happen, and definitely an interesting weekend to see how technology helped accelerate this. I don't know if you see this type of bank run without Twitter, without electronic withdrawals. If you had to go down to your bank to withdraw your money, these banks probably don't go under. But all it took was that asset sale and a couple of tweets from some big financial players about the bank. Peter Thiel was one who sent out a letter to his investment fund, and he said, take your money out, and there was a run on the bank, right? We think of runs on banks in Life is Wonderful, right? Bailey Savings and Loans. Everybody's there pulling their money out. There's not enough money to pay it, and every bank has that issue. Again, what the U.S. Treasury did was needed. I think it's the right move. I think it puts everybody in a pretty good position. It puts banks in a good position. It creates confidence with the depositors without burdening the taxpayers. But again, are these signs that the Federal Reserve has reached a threshold where they just can't push any higher? And has this threshold, has this pressure been enough to truly stamp out inflation, or are we dealing with a longer term problem moving forward? Sorry, I know this is a super long update, but important things to go over. We'll see what happens with CPI tomorrow. For our buyers, hey, there's an opportunity now to get back into these lower rates. We've recouped about half of our losses that we saw since the beginning of February. So rates are definitely moving a little bit lower for consumers. They have the potential to move lower from here, depending on what happens with CPI tomorrow and the Federal Reserve announcement next week. There could be a lot more room for these rates to move lower. So talk to you guys soon. Have a great week. Hope this was helpful. Have a good one.